Huge news that's wiping out $9 trillion of Americans' wealth. Now, here's the key thing is that right now, they're saying that current Americans' holdings of corporate equities and mutual fund shares fell $33 trillion at the end of the second quarter. Just so you know, the end of the second quarter is the end of June. They haven't even talked about what's happening in the fall yet. Okay. That's down from 42 trillion at the start of the year. So we're actually still waiting to hear the numbers. We probably won't hear the numbers for third quarter until closer to about Christmas time, unfortunately. But I'm curious to see what happens there because we had another down market going in. This article was actually written in September 27th, 2022. So this is the end of the third quarter, and they're talking about the end of the second quarter. So they're saying they've lost about $9 trillion in just the stock market. But wait, there's more. If you start adding the bond market losses, they say that we've probably lost between 9.5 and $10 trillion. Now, to give you some perspective here, right? If you go back 2020, it's actually in this article here. If you go back to that, you'll see here that says from 2020 to the peak of 2021, we went from 22 trillion to 42 trillion dollars, right? Well, that's a big jump. Now, you might argue and say, well, of course, like that was really fake because they were just pumping money in the system. That's very true. In fact, it created a massive cash bubble, right? So, yes, it drove all those equities up. It was huge. It just drove it all the way up out of control, more so than it should have. Just so you know, 2020 was happening. We were already in 2019, end of that year, getting ready to bear down for a recession. We were already seeing the writing on the wall. We're seeing that probably real estate prices were going to correct a little bit in certain markets. We were seeing that the stock market was overdue for a correction since it had been going up since 2009. It bottomed out in March 2009 after the last recession, and it just kept going up from there. So it never really took a break. But then all of a sudden, of course, market just kept going. We went to this massive euphoria. All of a sudden, people thought, "Oh, you can never lose money. It's perfect. It's wonderful." And then, bam! Even just in 6 months, really the first half of 2022, they're saying we've lost over possibly 9.5 to $10 trillion of money that's been invested. That's huge. Now, what I think is interesting, they say that the bulk of that wealth, that what happened went to those at the top, right? Because it's true. Mostly the thing that became really overvalued was the stock market, the value of the companies. This is why you saw Bezos all of a sudden jumping up on the charts. And we had Elon Musk jumping up as well. All these people are jumping up. Why? Because they said the wealthiest 10% of Americans own 89% of individually held stocks, according to the Federal Reserve. So they're saying this affects the 10% of Americans the most. And they'll even say that. They'll even say that the top 1% owned at one point owned 31% at the end of the second quarter, which is down from 32%. So they're saying now that the rich don't have as much of the market share as they used to. Well, that market share is fake, first and foremost. Okay, most of this are stock prices. I had somebody that made a comment on one of our videos. They said, "Well, come on, all the wealthiest Americans have stocks. They invest in stocks." I can understand why you say that. They have ownership in stocks. That is 100% true, but that is not true in the case that it's their company. They own it. They're not just the random person, the average Joe, investing in mutual funds or the stock market. These are people that already own the companies. They can control the factors that are going on with their company. But what's happened? Those companies started to slip, especially the tech companies, because they had a massive run up. There were zombie companies that were getting, I don't know how they even had a stock price when they didn't really have any business. They were just making money from possible future money to be made, right? It was just total zombie companies. All this stuff has been happening to throw it out of whack. So yeah, they're saying the share of wealth has slipped away. Now we've got the share of wealth held by the top 10% is now down to 68%, instead of 69. That's just because the most wealthy people, their value on the Forbes list was based on their stock shares. That doesn't mean that it's affecting them negatively in any way, shape, or form, because the stock prices really for them doesn't matter on a month-to-month basis. They're getting paid regardless. Who I should be most concerned about are those of us, I would say in the poor and the middle class, right? And middle class, by the way, even if you're a multimillionaire, you're still in the middle class, okay? At least in today's dollars. So you're looking at this like, yeah, well, that affects the top 10% more than anybody. That's true. Yeah, right here, they even say the bottom 50% of Americans have lost $70 billion in their wealth, in their stock wealth. Now, $70 billion doesn't sound nearly as bad as losing almost 10 trillion out of the total number. But remember, most of it's top heavy. Most of people, that wealth was in the value of the companies that those people owned. Again, that's money that's not like cash money for that bottom 50%. This is cash money. Many of this bottom 50%, they're counting on this money for retirement. They're counting on this money for their livelihood. This is the money that those that are baby boomers that are now almost all have been moving towards retirement age and getting to that point now. Now they're starting to say, hey, this is our money. What's going to happen if the market goes down when we're trying to retire? This is not a fun trip for them, right? And this is where there's a double whammy because, and this is what they're afraid of. They're saying if there's loss of values, there's loss of spending power. If there's loss of spending power, they're going to be spending money at the companies. If they don't spend money on businesses, American businesses, their stock prices go down, which also further brings down your retirement account value more. So when we're just seeing this start in 2022, we're just starting to see the stock market respond. Many people are saying, "Hey, the recession's over." There was just, a recent thing with the GDP came out. They said, "Oh, it's positive again. Recession gone. It only lasted for 2 quarters. We're good." Guys, that is not the worst of it, okay? First off, I think that there's still more to come. Just because it made a little recovery doesn't mean that there's not a bigger storm coming. It doesn't mean that there's not already a storm that we're in, but it might be the eye of the storm, right? We're just starting to see a little break in the clouds temporarily before the rest of the winds and the rains hit us even harder. This is why I really believe you're going to see this number increase over the period of time. I think you're going to see this number grow. We'll see more than just 9 or 10 trillion dollars of stock market losses. We're going to see a lot more than that. And that also, of course, affecting home prices, right? Especially if some home prices in different areas, that means there's less liquidity there, less ability for people to spend money. Everybody gets tighter with their money, put a tighter grip on it. They stop spending, and that brings everything down. It creates this real self-fulfilling prophecy of sorts. It just creates this massive cause and effect catastrophe potentially that could also drive your retirement accounts lower. This is going to put you in a place that is not fun. I'm telling you, could be put you in a very dangerous place, a precarious place if you're trying to retire anytime in the near future. And I even mean the next 10, 15, 20 years. This could set you back because inflation keeps going up, but your balances are going down. That's a double whammy. That's like getting kicked when you're down, literally. And watch, that's what's happening right here. This is the kind of stuff that we're trying to get away from. This is what we're trying to avoid. I don't want you guys being caught in this kind of mess, this kind of catastrophe where you're banking all your money in a market you have zero control over. This is why I had to stop being a financial advisor because I realized that the returns in the market weren't as good as everybody claimed. And I saw the reality. I saw what happened with Y2K. That's when I became a financial advisor. I saw what happened when people's wealth was being wiped out, especially when they started putting all their money in tech stocks and then they lost 90%. Tech stocks got hit hard, even harder than what they've been hit this year. I don't think we're done yet, guys. I don't think the bear market is over at all. I think we're just getting started. I think we're no more than halfway into this bear market. Why? Because people are still saying it's okay, keep buying. If people keep saying keep buying, I don't mean financial advisors. They'll say keep buying even when it hits the bottom, right? They'll say keep buying all the time because their commissions are counting on you buying more. But when the media is still saying, yeah, but it looks like we're going to get out of it, like there's still a little bit of hope. It's a little bit of denial of what's going on here. That's when you know the market hasn't hit a bottom. It'll hit a bottom when you start hearing people say, get out, get out, get out. Everybody get out. The market's bad. Get away, flee into cash, do whatever. When you start hearing mainstream media say that, then you know you've hit market bottom or you're really, really close to it. But we're not even close to that, guys. We just got out of a euphoric condition at the end of 2021. Now we're getting to the end of 2022. Now the market has a little hiccup. Yeah, it sounds massive that you're seeing 9 trillion, $10 trillion wiped out just really in 2 quarters, in 6 months. That's it. It was like almost like the money wasn't even there. We're almost going back to where we were just 2 years ago before everything went out of control. The problem is that now we're driving up interest rates like crazy. We're trying to catch up. We're trying to control all this inflation, which will also limit people in their spending. This also would probably drive up more credit card balances. I haven't heard many articles on this, but I would really believe that I think credit card balances are going up right now, while soon savings will be more and more depleted. And that's going to put us in a much bigger crisis. We haven't hit that point yet, guys. We're just warming up to it. Fortunately, people are still employed. Fortunately, people still have jobs. But what happens when that starts drying up? Because profits start drying up at companies, layoffs start happening, those people don't have money to spend, then it just cycles through and then it creates more of a recession. And if we're not careful emotionally, when people really get to panicking, that can create a depression, and that's even more dangerous. So the question is, do you want to have your money in a market like this where it's like your crazy ex-girlfriend or ex-boyfriend that you said, "Oh, they're toxic, get away from me." Do you want to be in this toxic environment or not? I would suggest looking for other alternatives, other ways to do this. Okay, so you're probably wondering, what's the answer? What do we do? If it's not the stock market, where? Well, check out this next video, how to profit in a market downturn. Check that out where I'll address that very specific question right now.